This is Rebecca with the Kat and Rebecca Show, Keep It Real Estate. And today we're with Brian Kavanagh from Franklin Loan Center. And wanted to kind of start off, and most of the people who call you and they're asking about loans, what's the most frequently asked question is where loans are concerned?
The most frequently asked question is, how much can I afford? Okay. And that's a very difficult question. It's different for everybody that's out there. But like I said earlier, there are three things we have to look at: income, credit, and savings. And that allows us to figure out a range of what they can afford. But taking it from there, depending on the loan program, also depends on what they can afford. Okay, there's the three basic programs that are out there. You've got your FHA, your VA, and your conventional loans. Those are the three. 90% of our loans are going to be based off of those three. And then there's 10% more that could be alternative loans or alternative documentation and credit loans or even hard money loans. If you put down enough money, someone's going to give you a loan.
So we did cover VA loans on a separate video. So if you're looking to a VA loan, please check that video out. But let's cover a little bit what makes the FHA unique. It was always considered the first-time home buyer loan.
Well, years and years ago when the Federal Housing Administration was set up, they were in place to make sure that everyone can own a home. Okay, so that's why it's known as the first-time home buyer loan. But that's not the case. And to define what a first-time home buyer is today is anyone that has not owned a home in the last 3 years. That makes you a first-time home buyer. So I haven't owned a home in 3 years. I can be a first-time home buyer. But back to FHA, FHA doesn't care if you've already owned a home or not.
Now, are there specific loans for that person who hasn't owned a home in 3 years, separate from the FHA?
There could be assistance programs that can help them.
That's a separate video as far as the type of assistance programs.
That is correct.
Okay.
Okay. But FHA will, if you owned a house yesterday and just sold it, we will let you buy a house.
Perfect.
We'll help you with that. Okay. FHA has a certain amount of guidelines that they follow. It's going to be based off of income, credit, and job. It's going to look over the last 2 years for the most part for your income, the last couple of months over your savings, and the last couple of years for your credit. Okay. What they allow for is they insure their own loans, so they don't have to worry about private mortgage insurance companies helping to insure those. They do it themselves. Okay, or you as the buyer help contribute to that insurance. They allow for unique situations. They can look at an income situation a little bit different. If you've only been on the job for a certain amount of time, but I can prove I've been working other places for the last couple of years. They allow for higher debt to income ratios. So they will go higher, they'll take more of a risk to allow you to go higher. More of your debt or more of your income they'll allow to go towards that debt, whether it be housing, cars, credit cards, student loans, and whatnot.
So debt to income, just for anybody who's listening, which is a normal term, it's just how much of your income is spent on debt. And there's a percentage, and that's that ratio.
Correct. There's a percentage for that. And for the most part, most lenders like to see it under 45. Sometimes FHA, they'll have a different risk factor and they'll allow it to go higher. Another thing FHA does is credit scores, where conventional loans require a 620 or higher credit score. FHA will go down to possibly a 580, possibly even lower than that, depending on what the situation is.
So it seems like the FHA will be a little bit more lenient in some circumstances where conventionally you're going to have a little bit more stricter guidelines.
Correct. They're going to be a little bit more lenient, a little bit more gentle, and they allow you to, creative is not the right term, they allow you to explain your situation more.
So, and then I will assume, since I've done this a few times, that when you have a conventional versus FHA, that you're going to have rates that are different based on how well you qualify or not, or how more complicated the loan may be.
That is a little bit true. FHA has a different rate structure than conventionals, or than hard money, or than alternative loans. They're by the Ginnie Mae bonds that are out there. Okay. They will vary depending on the property that you buy, whether it's a condo or a manufactured home or a single family residence. And they'll vary slightly on credit score, but not a lot. For the most part, it is what it is, and they just have slightly different adjustments depending on if you have really low credit scores or depending on the property.
And that's kind of important too, because somebody, if they're going into a manufactured home as their first home, paying a little bit higher rate, and they talk to their friend who's buying at the same time a conventional home, think that there's some problem with that, but that is typical throughout the industry. So you have to be aware that each buyer is separate, each property is separate in the circumstances, so that it all plays into what you're going to be paying for that mortgage.
Correct.